Yeah.
All right. Hi, Abhishek. I'm glad that you're taking the time out to help me with this the understanding of the new NFO that you have from PGIM stable. Ladies and gentlemen, in call we have Abhishek, and Abhishek is director of sales and products at PGIM. He's going to be walking us through the current newest offering of PGIM, which is in the real estate space. It's called the PGIM India Global Real Estate Fund. So did I get that right, Rakesh? I'm not too good with names.
Yeah.
All right.
Yeah.
So Rakesh, here's what I
No,
would
thank
like
you,
to,
Sharath.
right?
Thank you.
So please go ahead, give us, the stage is completely yours. Go ahead and tell us what's unique about this offering and why now, what kind of an audience are we looking at for this kind of a product, and everything there is to know for my investors to make an informed and educated decision.
Sure, Sharath. And first of all, thank you for giving us this opportunity. And if I was to be very, very specific and how this makes sense to an investor, I think one thing to understand very, very specifically it as at PGIM, whenever we are looking at launching a new product, we are extremely attuned to the requirement of the end client, first of all. So we are always thinking about what is it that is the biggest objection at a portfolio level, which is what you are going to be seeing maybe sometime out or maybe immediately in terms of being one of the biggest challenges. So when I talk about that, the precursor to that is that I think everybody is today worried about and is hearing more and more and reading more and more about interest and inflation, interest rates and inflation more so getting into a normalized territory against the last 5 years where it has been in the ultra loose monetary policy and fiscal response that the central banks have done, where inflation and interest were practically driven to the ground. Now, when you think of this as a background, to keep it simple from an investor's perspective, what does it mean? Till now, investors have enjoyed the benefit of somewhat carry or yield, as we call it, and then they have also benefited from the capital gain because the trajectory of interest rate was lower, right? So you were benefiting out of capital gains. Hence, the total return was still decently interesting. Now, when you are getting into a situation where your carry is limited and you are getting into a trajectory that interest rate will go up, on a combined basis, at a total return basis, you will face a double whammy of lower yield and a mark-to-market impact, which will be negative. Now that is one part of the story. The other part of the story, which is also important, is that what has it done to equities? When there was ultra loose monetary policy, essentially the cost of money was low. People were ready to take more risk, and hence anything which was high risk really was driven up. People are not so conscious about valuations, the multiples or the valuation that you are paying for that asset class. I think there will be a time very, 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 very soon in the next maybe couple of quarters or maybe a little more, and nobody is an expert in terms of timing these things perfectly, but by the logic of looking at emerging markets, central bank already hiking. So there are 12 such emerging market central banks which have already hike rates. Bank of England, Federal Reserve is talking about pulling out the excess liquidity measures, which means that ultimately everybody is signaling to a policy regime which will become more normal, and hence the interest rate and the inflation will become, come back into the normal scenario that it used to be earlier. Now, when you have that, your equities will also take a little bit of a brunt, and I'm consciously using the terms little bit of brunt. I'm not trying to paint a picture here that equities will not be relevant. Equities will continue to be a relevant asset class. In fact, when inflation firms up, equities benefit in the initial part. But all of us understand, while we run our businesses or while we go about our daily livelihoods, we'll realize that if inflation remains sticky for a longer period of time, even equities, the margins take a little bit of a hit. So when you have this background, you realize, okay, so then what do we do as investors? And I think we are clearly getting set up for a sub-optimal outcome if we are going to stay with our fundamental stock bond portfolio, or the so-called hybrid mix of 60-40 stock bond portfolio, for the precise reasons that I have narrated some time back. In terms of the response, that is why we are bringing in a product which clearly actually benefits for the same reasons that these two fundamental asset class are going to be a little suboptimal in terms of the outcome. So when you think of,
sorry, Abhishek. So everything that you shared with us so far in terms of data points, this was with reference to equities and the debt market. So the equity as an asset class and debt as an asset class, wherein what we're facing right now is inflation numbers going high, interest rates coming low, and because of this, we'll have lesser yields on our debt products. Equities will tend to be, while they will be relevant, they will be volatile in the coming years till the time that we don't see another cycle correction or whatever it is.
Sure.
All
Sure.
right. Okay.
That
So
is bang on.
now, so this is why, and that's why this particular product, in terms of now looking at real estate in terms of an asset class. So why don't we continue from there?
Yes. Yes. Yeah, perfect. So Sharad, thank you for summarizing that. And I think the key point here is that you are clearly bringing in an asset class which is already pretty relevant in the global market context. When you look at the broader backdrop of global markets financial portfolios, investors across the world have the largest exposure to bonds, second largest to stocks, and the third largest is to commercial real estate. Now, for Indian investors, that part is either negligible or totally missing in their financial portfolios. So that's the first point. Second point is commercial real estate will actually benefit when yields harden, because it will have a positive correlation to the rental yields per se. If I was to just make it very, very simple, it is ultimately the rental yields that becomes one part of the returns for real estate as an asset class. The tools or the instrument that we are going to be using is called real estate investment trust in very, very simple terms. And I don't think we need to oversimplify it, but if I was to just give you quick benefits of having a real estate investment trust, it is very much like a mutual fund of equities, where you are actually bringing together similar properties into a portfolio. It is being operated by a professional manager, which adds value to it. So there's not only a variable of yield, but also a potentially high capital appreciation that will come through, because these will be sought after properties in their own segments. This combined with the fact that when you look at the global backdrops, there are segments and themes which are growing, and some of these segments and themes are extremely pronounced in the global market. So when we talk to when our investors will be looking at their portfolios today, they will be very excited looking at some exposure to technology, because they're realizing everybody across the world, including our Indian corporates and institutional investors, are looking at doing technology related adoption capex. Now, when that happens, data centers become very, very important, because the server is going to be put in somewhere, right? Now, there are REITs which are servicing this requirement. In the Western world, you have more than 30, 35, 40% of the population which is beyond the 65 years of age. So for the same reasons that demographics are going to be yielding rich dividends for India, the same demographics are not so much helping some of the developed market nations. When you think of it, a segment like senior living, assisted senior living, coupled with high quality healthcare facilities, is something that the investors there are very clearly lining up for, because not only are they getting older, they are getting sicker, and they are wealthier. So the wealth effect has already played out, and those kind of facilities, unfortunately, not available in India yet, especially in a financial product format. But these will give you extremely attractive yields and investment opportunities. Then you have, I think there's a phenomena which all of us are witnessing. So in Mumbai, when I'm driving back home, I see those big basket ads, and sorry to take specific names, but it's something which comes to the mind at first. But what it says is your grocery will be home before you are home. So 20 minutes delivery commitment. Now, all of us would understand that it won't happen if your warehouses are not in the very vicinity or bang in the center of the city. You can't really do with warehouses 40 miles out of the city any longer, which means this is prime real estate properties, which not only will command higher premium in terms of yields, but also a high potential capital appreciation. And this is a phenomena which is available world over. So the example in India is just a very small one, but when you look at world over, this phenomena is very much at play, and it is not a phenomena which is isolated to just groceries. It is a phenomena which is impacting each and everything that is required on a daily basis, as well as even specialty goods. So warehousing has become very, very important. If I was to just at the cost of sounding a little more jargonized, when you think of inventory management, uh, the inventory management concept has shifted from just in time to just in case. The China plus one concept that is very much ruling the roost today from the larger companies and investors' perspective. So when you think of this as the background, so most of these sectors are not even present in India, or at least are not present as a financial product opportunity in India. Not only that give you extremely sustainable and durable yield opportunity or income opportunity, but also gives you a durable opportunity in capital gains.
Okay.
Now you think of the third component, which is that when the world's smartest and the largest investors realize that this is what is at play, and they have already realized it, you will see a phenomena where you will have a high amount of demand building up for this as an asset class. It's already started building. You pick up, and this is not something that that you need to look at PGIM for. You can pick up a report from Morningstar. You can pick up a report which talks about sovereign wealth funds, private wealth funds, country-specific funds, which are today allocating more than 15 to 20% of their standing allocations into REIT as an asset class. So if you extend that point, I would say that for an investor today, if he believes, that inflation and interest rates are going to normalize, then this is one of the most pronounced instruments available in the global markets place, which not only insulates him or protects him from that phenomena of inflation hike or interest rate hike, but it benefits, in terms of higher yields and higher potential capital gains. Also, the fact that it will be driven up by larger money chasing this asset class, as soon as they realize it, it will only accrue more capital appreciation for you. And the good news is that though it may be debatable a little bit, the good news is that you are practically at the beginning of the cycle.
Okay. So I'm going to be asking again a very elementary question just to break the jargon here, right? Because India, unfortunately, most of investors have real estate in physical ownership, which means they either have residential real estate or they have, very few of them have commercial real estate, depending on the net worth of the client. But alongside with that comes all the hassles about paperwork, taxes, charges, underneath the table, over the table, all of these other kind of movements of money. Now, how is this particular fund, while it's real estate, how is it different from the traditional way a retail investor would go about buying real estate?
Okay, so very, very important question. I think I should have probably addressed it at the beginning of it. But when you look at the construct of it, these are high quality properties which are serving specific needs, in the global parlance. For an individual investor, it is practically impossible because the ticket sizes are going to be extremely high. So if you're going to be going and trying to access this in terms of a part of your portfolio by buying direct properties, these are going to be very high ticket items. Practically impossible for a mid net worth or even a high net worth investor to look at these properties in the global parlance. Second is, the big differentiation of professional management that comes into play here, because these are essentially, when you look at PGIM is the second largest global manager of real estate assets in the world today. It manages $190 billion, which makes it the second largest. And 90% of that book is essentially in the private market, which means that not only you have an unbridled access to information, but you have a very, very strong proprietary book to be able to make valuation modeling, as well as understanding what will happen when, in terms of, and keeping a very, very logical benchmark to it. So I think that information advantage is going to set us apart. And I don't think an investor who goes and directly accesses these asset classes will be able to do that. At the same time, let me also put it out there, and this is something which is available as at a geographical level. Even in the public market space across the world, that if you were into segments that I mentioned earlier, let's say a data center, or let's say logistics, warehousing, last mile retailing, senior living, self-storage, and you were not into the so-called basic segments like residential apartments, the old concept corporate offices, or the office spaces as we call it, regional malls, or your local mom and pop stores as we call it, then I think you would have anyways done a big job of being able to capture a huge positive return. Because you need to understand that, or as an investor, what we need to really understand is yield or income is only one component of the overall return. What will play out over a holding period or a total return for a customer is income combined with growth opportunity, because that will drive up capital appreciation opportunity. And three, what the larger money or investors who are sitting with larger deeper pockets of money are buying, and they are clearly going to be backing growth oriented sectors. So again, going back, and at the cost of being repetitive, if you very clearly know that capex is being attuned to technology adoption, clearly data warehouses cannot be ignored. If you clearly know that demographics is tilting towards senior living become a more sustainable concept, it's clearly a segment which will grow. Self storage, because people have done reverse migration thanks to what we saw in COVID. They have left high value properties in places like Frankfurt, Manhattan, Vancouver in Canada, and so on and so forth, and they've come back to their own homes, but they know they will have to go back if they have to keep the jobs at some point of time. They have kept things for self storage, so that is the requirement for people like you and me who will be doing their jobs and are in the larger cities, but have moved back home for the time being. For ultra high net worth individuals, self storage can mean different things. So if you have artifacts to store, if you have store your yachts, if you have a huge car collection, you want to keep that as a very, very secure storage facility. I think all those things are very, very clearly available in the self storage concept. So it goes in terms of the different profiles that are available in the self storage segment, and goes without saying that not only do they command a premium yield, but these are going to be high maintenance properties which will attract more and more capital appreciation.
Got it. So what I'm hearing you say here, Abhishek, is that first things first, we are not buying a complete large property as a retail investor would actually go about doing. And what we're trying to do here is get the mutual fund route, buy large pockets of real estate that is managed by a fund manager, and that funds raised are done by small units as small as 5,000 rupees by retail investors. Right, the same logic of why I would not go about directly investing in stocks.
That's right.
So as a retail investor, I save the hassle of managing,
that's right,
picking up assets, taxation, evaluating whether documentations, legalities, and all of the burden that comes with traditional real estate investing. I'm putting that in the sites. I'm getting an opportunity to invest in global markets. So I'm assuming because of all the different verticals you spoke about, I'm assuming there is no exposure to India at all.
No, not as of now.
Okay, so this is predominantly a global fund. So with that said, I'm assuming this is going to be a fund of fund, which means money is going to be collected from PGIM India, one fund, and then it's going to go into
correct.
A feeder fund abroad. Okay, great. So can we understand
That's correct.
What's the current assets under management in the parent fund?
So in the parent fund, we manage $800 million of assets under management. That is the specific strategy that we are going to be feeding into. But as I said, at an overall level, PGIM manages 190 billion plus of assets in the real estate segment in itself, and a large part of that is in the private real estate book.
Understood.
So one of the points, Sharad, that you mentioned, it's very, 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 very one of the points, that you mentioned, and which is very, very important to really maybe reiterate, is that big benefit of professional management. In terms of deciding what to buy, how much to buy, and when to sell, is going to be that one critical differentiation which will determine the ability for this product to really see that outstanding performance. If you're going to buy the whole bucket, like for example, if you're going to buy the whole market, and if let's say the market which is represented by, in this case, let's just take BSE 30 as a benchmark. And if you think that the BSE 30 companies are not going to grow as much as the broader market is going to grow, but if you're limited to the benchmark, then clearly you will not make those differential returns. But at a nominal growth rate, the rest of the market is also growing way, way faster. Here you're clearly looking at a mandate where we are buying just 30 to 45 securities within real estate investment trusts and real estate operating companies. And these are going to be the most high conviction bets across the PGIM real estate universe.
Understood.
So when you put that together,
please.
Essentially in simplistic, sorry, what I was saying, that in just simple terms, we will buy more of what we like and what we have more conviction on, and we will just not own what we don't have conviction on. While I make that point, let me also put in a disclaimer that at a geographical level, so for example, if at a benchmark level, North America is about 60, then we will be plus minus not more than 2% plus and minus to that at a geographical level. And there are reasons to do that, because from a risk management perspective, for something like real estate, geopolitical risk is one of the biggest risks, and you don't want to really try and expose yourself too much. And this is a normal guideline in terms of anything which kind of gives us the reasons to believe that you should not just be in geography at all. We will obviously take that call because it's an active fund at the end of the day. But what is the differentiator is that within that geography, as I'm keeping on harping, there are sectors which are growing well and there is demand for those sectors. And then there is those fundamental sectors which have been there forever. There is a huge disparity between the two. And we can, just own the high growing sectors which are available at reasonable valuations and totally disown the so-called fundamental, segments of real estate which have been there for years altogether, but are not growing any longer.
Understood. Okay, fair enough. So, Abhishek, what I'm going to get at right now is, so we have real estate now. We bought this is a global real estate fund. We already have a couple of REITs available for investors right in the country without you having to take the debt taxation route, because since it's a fund of fund, we're going to be looking at the debt taxation. So why opt for this particular alternative as compared to the ones that are already available with let's say more effective taxation?
So that's a very relevant question, Sharath. And I think let me first highlight what are the benefits of some of these local REITs. And let me tell you that I think the REIT, though there is only 3 securities available in the Indian market today, they combinedly represent 56% of the outstanding office space, the quality office space that is out there in the Indian markets. So between the 3 REITs, you're covering that much of the inventory, which is a very, very good thing, which means this as an asset class is catching up big time. The only lacuna from an investor's perspective, when I put myself in an investor shoe, is that this is very much isolated to just one segment, which is corporate office spaces. Mm-hmm. And come as a situation like COVID, you see a big downturn, which is attributed to the fact that everybody who's worth their salt were also not having answers as to how corporate office spaces will be approached at after everybody realized that hybrid work structures will become the norm, right? What we are realizing is that there are portions of these office spaces which are extremely, extremely relevant, and in fact will gain relevance because people are realizing that decision makers cannot be sitting at home. They will have to be in office. They will have to have those critical decisions made with their teams, which will ensure better efficiency. But at the same time, the protocols of safety ensure that you will have to possibly allocate higher square feet spaces per person than what you used to do earlier, which means larger office spaces in more cases than not, high quality office spaces. At the same time, there are trends in the world market where if you need investor money, you will have to be highly conscious of ESG factors. So you talk about the social factors, the governance factors, as well as the factors like that the buildings should be energy efficient, sustainable, high on utility and amenities, and so on and so forth. Now, why is this piece of information important? Because when as an investor you are going to actually see numbers, you will realize that these high quality properties, which are essentially called grade A commercial properties in the developed market parlance, actually command yields which are more than double of your usual plethora of office and commercial space assets which are available. So if let's say the usual number is 3 to 4%, the yields that a grade A commercial office space command could be between 9 to 10%. Now that's that is without the capital appreciation ability. Yeah. So I think that phenomena of having disparities and hence dislocated opportunities, which clearly offer you some significantly better opportunities, is what a professional manager can scope for. And hence, not only do you get the benefit of efficiency, a common goal, but also the big benefit of professional management that comes through.
So what I'm hearing you say at this point in time, Abhishek, is the fact that with vis-a-vis REITs that are currently listed in the Indian stock market, vis-a-vis the current opportunity that PGIM is coming along with, is that all of my inventory that I have in the REITs in India, right? It is only for grade A commercial properties, and I'm risking everything around India as a geography. However, the PGIM NFO that we are currently having, it's across the world, mostly developed market, where we are not just investing in one vertical as such, but the multiple verticals why you need commercial spaces, and commercial spaces here being not just office spaces, but everything else, right from toll bridges to infrastructure projects to data warehousing, senior assisted living, and hospitalization or healthcare for this, and so on and so forth. Is that correct?
Correct.
Awesome.
So you are bang on. Just a slight correction. The India REITs, the 3 India REITs, represent office spaces. Not surely everything is grade A, but they give you an access to office spaces in India, the good quality office spaces. The grade A commercial property example was more so with respect and or reference to the properties that are available in markets like developed North America and even Europe. And that is the yield that they command. The number that I spoke about are the numbers that are being commanded in developed markets. So that is what makes it even more interesting.
Got it. Fair enough. Awesome. What else would you like to share with our audience today, Abhishek?
So one of the things which is important, and I think everybody, while the whole thesis sounds very, very compelling, what is also important to see is that if something like this has happened in the past, how have these asset classes behaved? And I think it is very, very important to build up a reference, though I want to clearly put in a disclaimer that not everything in history has to repeat itself, but it's always good to develop some comfort by putting in some reference points. And I think I obviously took the initial extra time in terms of building up the reference point on the interest rate and inflation normalization. I'll go back to that and tell you that when it was the normal time, for the longest period of time, even if you were to look at 40-year data or even 50-year data, you will realize that REITs as an asset class at the global level has beaten broader equity as an asset class for 40 years, or for that matter, 45 years. If I was to quickly put those numbers in context, and these are numbers which are available in our marketing material, these are numbers at a benchmark level. So it is not even building in the extra returns that an active manager can provide, but at a broader index level itself, the FTSE EPRA NAREIT index, which represents the entire developed REIT as an inventory at a benchmark level, has delivered approximately 12.3% returns. This is data all the way back from 1972 all the way to 2016, which is a 45-year period. In the same time frame, stocks which are represented by S&P 500, which is essentially the US representative, the broadest US representative of equities, has generated 10.18.
Wow. Okay.
For the same 45-year period. Okay. Come 2016, and I'm really again going back to that same reference point. 2016 onwards, when you got into ultra loose monetary policy, your rates and inflation was driven practically to the ground. 70% of the developed market bonds were either yielding 0 or negative. In that time frame, also REITs has generated 8% plus returns.
Okay.
Whereas equities has done way better. Equities generated 17.5% compounded.
Understood.
So again, going back, the thesis here is that if you look at this asset class as the asset class which will benefit because of the normalization, And if you have a view that interest rates and inflation are going towards normalization in the times to come, then here's an asset class which has remained or which has sustained high quality performance with the benefits of diversification in the global market for the longest period of time.
Got it. So let's draw an ideal client avatar for this particular product. Right now, you have those investors who are purely looking at debt or FDs. Let's say retail investors predominantly looking at debt, FDs simply because of the fact it's secure, etc., etc. And then you have that breed of investors where risk hai to ishq hai type. So we're talking about people who are completely equity oriented. This product class, what I'm looking at is, if we are considering a 3-year to a 5-year period, we have this one would beat debt product hands down for two reasons. One, that you got consistent flow of rental yields coming in. Two, with a decent period of time when the cycles improve, we're talking about capital appreciation as well. And more so, we're also looking at getting the currency arbitrage that we're going to be getting. Is that correct?
That is bang on, Sharat. And if I was to, maybe repeat a few points that you said and just build upon that, I think the biggest advantage for an Indian investor today is that you are getting a non-rupee asset, which is also non-equity.
Right. Okay.
So rupee actually covers the bond part of it, and it is also non-equity. So when you think of it, again, going back to the same point that we initially started with, which is that the usual 60-40 stock bond portfolio, which is going to end up giving you suboptimal performance if you believe in the thesis that we have spoken about during this interaction. Then I think this is clearly an asset class which is a solution which you need in the portfolio, and it is clearly an alternative to any other income generating asset. At the same time, it is also a very, very good complement to a high growth capital gain asset like equity. So I would say, it goes smack in the middle as far as an asset class is concerned, with very, very different characteristics and a very, very insulated profile to some of the headwinds that we discuss in terms of inflation and interest rates.
Got it. So from an investor's perspective, from an asset allocation perspective, we're looking at investing in a product that is physical in nature. It is not just paper-based investments. So while the investment route is online or through the paper, but you're holding physical assets and not necessarily equities or debt, which can be rigged, if I were to say very loosely, depending on situations in the market.
So you I mean, it's very accurate what you say, because when you think of it, at the bottom of it, there is hard assets which are going to be, as far as it is occupied by good quality tenants, and that is a job which PGIM Real Estate can potentially do very, very well, of identifying the right properties which will always be of use. And as far as it is occupied by good tenants, you will always have a stream of income flowing in, whatever may be the scenario of inflation and interest rates. Now, last 40 years data suggests that year on year, whatever the inflation number has been, the income profile of REITs at an aggregate level, year on year, I'm not talking about an average number, I'm talking about year on year, has outpaced inflation by a huge margin. The average outperformance is 4% compounded.
Interesting. And
so even in a year, now let me drive that point home. Yeah, sorry, I was just going to give you a specific pointer in time. 2015 is when inflation really was driven to zero and negative territory, right? This is when the ultra loose monetary policy came into effect. And in that year also, the average income profile of REITs at an aggregate level was somewhere in the vicinity of 4%. So where interest coupon bearing instruments would have given you negligible return through yields, if you would have invested at that point of time, a REIT would have still given you positive income flow. So you are bang on when you make that point.
Sure. Okay. So since we're speaking numbers here, and for some of our Indian investors, 4% will look very loose considering how the markets have been so buoyant nowadays, and they're like, what do I do with the 4%? But you're saying 4% in terms of dollar returns. Number one. Number two, it's not
Four
going
terms
to,
is yeah.
and it's not going to be volatile as how the markets are as such.
So yes, as I mentioned in our chat earlier, I think a couple of times, that the overall return for the investor here is going to be determined by one large portion being the yield or the income, which is not going to be volatile for sure. The second part of it is dependent on the quality of the property and hence the capital appreciation for that property because of the demand for that segment. Which to my mind, I think is the job which PGIM real estate is very well cut out to do. And the third portion is the market related demand supply. Since this is a listed real estate investment trust or real estate operating company, Sharath, it is important for you and your investors to clearly build in the point that it is listed at the end of the day, and hence at an overall level it can be volatile. It has been volatile, it can be volatile, but when you look at it over a cycle, because of the specific reasons and nature of the asset class that we discussed through this conversation, you will realize that in a mean reverting inflation and interest rate scenario, the asset class is going to be only behaving better.
Understood. So now let's get the other. Let's address the devil in the room, right? Why not gold? I can have my money in gold as well. That's another asset allocation, right? I know the answer, but I'm just asking this in behalf of a few of our investors, and especially we're talking about Indians, and we have a very fond love towards gold. So how do we address that?
No. And frankly, Sharad, I would start by saying that there's nothing wrong in owning some portion as gold, frankly. And we at PGIM, in all our investment thesis believe that your core portfolio should always be diversified. So when I make a point about REITs being a very, very important tool to be able to hedge against inflation and benefit out of capital gains, I am also conscious that in a hyperinflation scenario, gold will come to your rescue. Uh, you know, and then you can, that's a job which, as an advisor, as an MFD, as manufacturers, we need to do in terms of educating our clients that when you are looking at a diversified portfolio in different cycles of time, you will benefit in most of them. But if I was to become very, very specific, I would say the biggest differentiator is that gold has no end use as an asset class. It is only an alternative store of value. Whereas here we are talking about a physical asset which is giving you accrual yields. Here is an asset class which will potentially go up because there is a real demand supply for that asset class for end use. Gold, ultimately, the price is going to be defined on the basis of demand supply for a particular period of time. Now, in the last 1 year, inflation has gone up tremendously well for the global markets as well as the Indian markets. When you look at how gold has performed, it is not giving you a very encouraging picture of that. At the same time, I'm conscious that if it really goes into a hyperinflation scenario where inflation is just going up and up and up, that is a time where not many asset classes will be able to beat gold. So there is a reason why gold should be in your portfolio, but then there is a equally good reason why an income generating asset has to be in your portfolio as well.
And I think more so, the cycle of gold is much longer when compared to real estate. The way I see what you're talking about, because a 3-year to 5-year cycle is when you're looking at getting a stable return as compared to gold, which is generally a 9 to 12-year cycle.
Sure. So, ultimately it is all going to be a function of, what will prop up which part of the asset class. So as I said, there has also been a cycle where gold has just not done anything for a very, very long period of time in history.
Yep.
And then there has been a time exactly which you are referring to where the cycle of gold has been long enough. Clearly, there are commodity super cycles, and gold clearly falls in that part of the super cycle as well. But I would again bring back the point to a 45-year period data which I referenced to. And I'm pretty conscious that even if I was to stretch that data to a 50, 60, 70, 80, 100-year period as well, you will realize that an income generating asset would still have its play in a normal economic scenario. The reason I'm not able to give you that data is that REITs were invented in 1960. You didn't have REITs before that. So 1962 is probably the, when you think of an index level, we only have data from 1972. We couldn't get our hands on data prior to that, but I think the 45 years period is sufficient enough. We would have, if I put into context, we have seen about 9 business cycles minimum. Because if you look at 5 years being a business cycle, then you have seen 9 business cycles, many more market cycles, because generally a market cycle is now looked at between 3 and 5 years. So many more market cycles than the business cycles as well. And I think through that, real estate has remained very, very relevant as an income generating assets, and even outpacing equities in normal scenarios. Again, it is not about saying whether it should be gold or REITs. It is more about saying that an asset class which is today not present and available for Indian investors to invest into is something that PGIM is bringing in. It is very, very unique in terms of characteristics which are going to be benefiting out of the biggest challenges that you see forward. And I'm sure when you will be thinking about it from your investors' portfolio, one of the challenges would be how to position your portfolio with respect to higher interest rates and higher inflation. So it is clearly an answer to that.
Got it. Awesome. So I'm pretty much done with everything that I needed to ask you, Abhishek. Is there anything else you'd like to tell to your potential investors? We've got a good client base that's got exposure to PGIM as a fund house, but specifically for this particular fund.
So the only thing which I leave with, and I know that, as an investor, you need to see an evidence of the concept. And I can tell you the benefit for this product, though it will come as an NFO in India, it is not really a new fund offer, because it's an existing product of our parent company, which is existing for 7 years now. 2014 is when it incepted. Some of the specific pointers or characteristics, like buying the 30 to 45 securities only, which are the most high conviction ideas, having a team which has done this over 50 years, having a prop book which is very, very large, and hence the valuation aspects of it are very, very well controlled. The information benefit that you have for asset classes, the benchmark is very, very well controlled. Apart from that, in realistic terms, when you look at the performance of the underlying fund at a parent strategy level, even in the time, and I think I referenced to the last 5 years as being one of the most challenging times for corporate real estate, quite a few number of times in our conversation. Even with that as the reference point, the asset class has been able to generate a 12% compounded for the last 5 years, and since inception, more than 10% compounded returns at a parent strategy level. And all these numbers that I'm talking about is in dollar terms, and at net of fees level at the global level. So yeah, so that's what we bring in the same time frame. If you were to look at the benchmark has delivered half the returns that I spoke about. So that active management point that I necessarily mentioned about the ability to really differentiate by buying the right assets is very, very clearly visible in our track record.
Awesome. Thank you for the time, Abhishek. I'm glad that we invested this time in better understanding your product offering. I'm pretty certain you all are going to get the similar kind of success that PGIM as a fund house has been having over the last couple of years. So all the best to you guys, and thank you once again for taking the time.
Thank you, Sharath, and thank you for taking out this time to get us this access to speak to your investors. I'm sure they would find at least some parts of this conversation useful while they are thinking about their financial wellness. And at PGIM, we have always maintained this, that if you can't bring a solution, just giving a view is of no use. So we are always going to be solution oriented, and I think that is clearly visible in our product portfolio. But thank you again for this.